What is MACD? MACD stands for Moving Average Convergence Divergence. That's what MACD is. Now, MACD was created by Gerald Appel in the late 1970s. So MACD is like 50 years old. However, even after 50 years, it is the best to gauge the strength, momentum, direction, and duration of the trend in one picture. So you can have them all these important stuff for trading in one picture. That is strength, how much stronger it is, the stock, momentum, if it is going up, down, what is the momentum, how fast it is. Basically, momentum means the fastness. If you throw a toy car, it goes at a faster pace, but at the end of the journey, its pace reduces. So its momentum in the start is fast and its momentum at the end is slow. That's what momentum is. Then there is direction, if it is going up or down. The momentum with the direction will help you make money. And then there is a duration. For how much duration is the trend in motion? So that you can get out with money. Because if you will delay, the money will be gone. MACD shows two lines. First one is fast EMA. Exponential moving averages EMA. And second one is slow exponential moving average. Now, what is an exponential moving average? Now, the difference between a normal moving average and an exponential moving average is normal moving average takes all days as equal, but an exponential moving average gives more weightage to the last few days rather than the first few days. So there is like more weightage given to the last days. And in MACD, the first line is extremely fast. It's the short-term fast movement. And the second line is the long-term slow movement. So you have to, you can see both the trends, the long-term, the short-term. Most commonly used values of MACD are 12, 26, and 9 days. MACD uses historical price date, mostly closing price. Now, MACD divergence is a strong signal of change in trend. Now, we will discuss divergence in the next few chapters, and I will show you how it helps you to trade and make easy money. Now, MACD in detail. Now, although we will discuss it on chart as well in the next chapter, but just to give you an overview, the first thing to note is signal line crossover. Whenever the shorter term fast moving average crosses the longer term slow moving average, it means that the shorter trend is up. So it's easier to make money on the buy. If it crosses on the downside, that is, it's crossing the red line on the downside, then it's easier to make money on the short sell. Then comes the zero crossover. Whenever the MACD is above zero, there is a higher chance, there is a double chance to make money on the buy, because above zero means good for buy, below zero means good for short sell. Then comes divergence. If the MACD is falling but the price keeps on rising, this means there is something wrong, and usually MACD divergence means that someone big is selling but he wants the price to stay higher so that he gets the highest profit, and once he's out, the price falls. Then comes timing. When to enter, when to exit, and for how many days. What's the duration, so that you can get out with profits in your account rather than losing all those profit and end at zero profit. Then comes double lows and double highs. These on the MACD tells you when the trend is about to change. So that's what is MACD.